Welcome to the Market Moment. My name is Matt Walters here with Lee Mackey, and we've got a good conversation today. But before we get started, remember to join the online growing community at the Market Moment YouTube channel, I guess. Yeah. So be sure to give us a like, subscribe. We appreciate it. We're trying to put out a lot of content. We've got short videos. We've got 5-10 minute videos, and we've got the podcast. So trying to put a lot of stuff out there. We're having fun with it, trying to get better. So we appreciate the support. It goes a long way. So today we're going to talk about everyone's favorite topic, elections. So we have an election coming up, and we're getting this question a lot, naturally, from clients, people we're talking to. You know, it just seems like everyone's talking about it. It's you know, the major headlines on all the news stations with everything going on with Biden and Trump. And so we thought we'd jump in here and spend a few minutes talking about kind of what that means from an investment perspective, but then also things to look ahead to if the election does go a certain way, maybe from a tax perspective and some planning opportunities. So,
this entire election season has been weird. You know, typically you have primaries. Or are they called primaries? Where you have the Democrats running? Yeah. Mm-hmm. You know, it was a foregone conclusion that obviously Biden was running for re-election. He'd get the Democratic nomination. And, you know, it was pretty much a no-brainer, you know, on the Republican side. So there's been no drama in each party. I mean, it's been Trump versus Biden pretty much the last
there's drama now.
2 or 3 years. There's a little drama now.
Yeah. On the Democratic side,
yeah.
Just in terms of like who's going to be their candidate.
But, you know, you've probably experienced it. You know, most of our clients, one of the questions they ask when we give them an opportunity to, you know, what's on your mind, they want to know, how does the election affect the economy, the markets, my money? And so that's why we just kind of decided, hey, let's get in here and talk about it a little bit. Yeah.
So if you just look at history, okay, so I think this is a good place to start. So we have friends, clients, people in our community that fall on different sides of the aisle, right? We live in Arkansas. It's generally a more conservative state and area. But we absolutely have different. And so, you know, you see both sides in terms of like, well, if so-and-so wins, is that going to be bad for the stock market? Because, you know, I don't agree with their policies and it's going to be volatile and all these things. And like, should we make some trading and investment decisions around that? And so what's interesting is, and some people are kind of open to that not being true, and others are like we need to go to cash now and wait it out, right, in our extreme. And the reason you don't want to do that is the long and short is it doesn't really matter, especially in the short term, who's president, right? And so if you go back to 1950, let's say, and this is an extreme example, but let's say you were doing the extreme and you were like, you're a staunch Republican and you're like conservative and I'm going to be invested when Republicans are in control, Republicans are in the White House because that's going to be good for taxes and the economy and the market, but I'm going to sit on the sidelines when Democrats are in control, okay? And vice versa. We've got the data behind that. So if you look at the S&P 500 returns going back to 1950, if you were invested only during the Republican presidencies, your annualized return was 2.8%, okay? Didn't even keep up with inflation since 1950. The S&P 500 investment during only Democratic presidencies, going back to 1950, is 5.11. So not that great either. It's better, but it's not that great. A lot of people, right, the conservative side considers themselves, you know, business friendly, right, market friendly, Wall Street friendly. And so you would just think, well, the market probably does better. I bet if you went and asked 100 people, especially in this area, 80-90% of them would say market probably does better with the Republicans in office. Yeah. Is that fair?
Yeah.
I mean,
absolutely.
And it does, historically speaking, since 1950, about half of what it's done since when Democrats are in office. So 2.8 with the Republicans, 5.11. Again, that's if you're in cash during the opposing party's tenure. If you just stayed invested the entire time in the S&P 500, you did 8.05, right? So materially better versus trying to time it out and play it out based on political parties and who's in control. So initial thoughts on that, if any?
No, I mean it makes sense. That's oftentimes when people, clients, friends ask the question, they they they're looking for a specific answer, kind of like you alluded to. If they lean conservative, they want you to say, well, if in this case, if Biden wins re-election, then it's just going to go
Yeah, we're in
down
trouble.
horrible.
Yeah,
If they lean Democratic, they want you to say, well, man, if Trump gets in, it's going to be awful. And so, but yeah, that study shows. Stay invested.
And to clarify, we're not saying that like presidential elections don't matter, because they absolutely do. We're strictly speaking from a market's perspective, in returns, historical returns in the stock market, which you have to separate, right? Political policy, the economy, like those are different. The long-term trends and trajectory of the economy and policy and our nation as a whole is very different than what the market does over a 3 or 4 year presidential, term. So don't take this as we're saying it doesn't matter who's in office. We're just saying don't make especially short-term investment decisions around should we get more aggressive or more conservative based on the outcome or what the expected outcome.
I pulled an article that I found interesting. These are 3 myths. I can't even say that word. Myths about elections and investing. All right, you ready? Myth number 1, stocks don't do well in election years. So we're not talking about the entire presidency. We're talking about election years. They don't do well in election years. Going back to 1928, so we're going back further than you did. We're going back almost 100 years. In an election year, the S&P 500 has returned 7.5%. In non-election years, 8%. So can you say it doesn't do as well? Sure, but not materially.
Right.
7.5 versus 8. Myth number 2. Sorry about my mic. Myth number 2: markets will go down if so and so wins. This is what I was just talking about. Markets really aren't looking at the president. It's more the economic backdrop. Case in point, our last election in 20, we were in COVID, right? And so that was a big backdrop to the election. It had less to do with necessarily the president or the presidency. And then myth number 3, the Federal Reserve won't change policy in election years. They do. Now, I think it's safe to say they don't like to do rate hikes or rate cuts in the couple months leading up to an election. But as we've seen this year,
it's on the table.
It's on the table, absolutely. And so those are 3 myths that I thought were interesting. We've got some charts we may put up to kind of show that. But that's what we get asked about, the Fed. How does the presidential election affect the markets? And so
one thing I've always said is if there's any, just like we talked about, if there's any trend that the market does like, historically speaking, and I've got some numbers here to support it, it's the market likes a split Congress.
Yeah.
It likes gridlock.
Loves gridlock.
Right? And so if either party has too much control, there are good and bad things that can kind of come out of left field and get pushed through that are just less predictable from a market standpoint. And we know the market hates surprises.
Uncertainty.
And so if Congress is divided, then the market generally knows, hey, there's going to be some policies that get pushed through and changed, but there's going to have to be some common ground for anything to get passed.
Yeah.
And so if you look at when a Democrat is president or a Republican is president, and the market returns for the different times when Democrat president and they controlled Congress, or Democrat was president and the Republicans controlled Congress, and all of the different scenarios, both scenarios when Democrats or Republicans were presidents did best when Congress was divided, right? And somewhat material.
And it's so counterintuitive. But when the markets, if the markets can go into the thinking there's not going to be a whole lot done in Washington, they like that.
Sure.
Now, we may look at it and go, well, that doesn't make sense. But from a market perspective, they just do not like
because businesses, to a great extent, now they want, corporations want low corporate tax rates, right? We'll get into that here in a second. And They want certain things, but at the same time, a lot of it's just like, leave us the heck alone.
Yeah.
Just stay out of let us run our businesses, let us make a profit, grow those profits, and just stay out of the way. And so that's why they like gridlock, is because, they feel like, I think for the most part, they'll probably be generally left alone.
One thing that is seen in election years is increased volatility. We'll probably begin to see some of that as we kind of head into November. But one thing that is clear too, that if we begin to see, if it becomes apparent who might win, markets will probably tend to settle down a little bit because of the uncertainty factor. We saw it with, and this is going back, 20-something years ago with Bush and Gore, when you had all the election issues and the hanging chads, and the markets didn't like it. Because we had a period of weeks where we did not know who was going to be the president, and the markets didn't like it. There was a lot of uncertainty around that election. So
and I think so. You saw a very small glimpse of that here recently when I think the general public and the general population, I think the chances of Trump winning has increased with everything going on with Biden. Not saying he's going to, not saying who knows what's going to happen. But if you look at what the market did after some of the performances from Biden and questions started coming in, the market liked that. And I think, you might say, well, you just said it doesn't matter. Well, to your point, it's just the sooner the market knows who's going to be in office, the better, because it's like there's not that hanging question.
And they can begin to factor in
right
the likelihood of, more tax cuts or higher tax rate. Yes.
And I think the one thing that matters this election cycle from a market perspective is, going back to 2017, you had the Trump tax cuts. I think it was 17, right?
Yeah.
When that got passed.
Yeah.
So, and those are set to sunset January 1st of 2026. So we have 18 months left of corporate tax rates being at 21% versus 28, right? And that's material. And so I think the market looks at that and says, hey, the chances of those corporate tax rates being extended and maybe not permanent, but being kicked down the road further is much greater if Trump is in office than if Biden's in office. And so I think if you wanted to look at any one thing that would be a positive, outcome for the markets if Trump got elected, it's that one specific issue. Crickets.
Oh,
I was just looking for some affirmation or some.
100%.
Yeah.
And it goes to what we were talking about earlier. Like you said, the sooner they can get that. Another thing. I think there are three ways that the elections can affect these current markets. One, you said, were the tax cuts. That's on everybody's mind. That's one reason why we're doing a lot of the planning that we're doing with Roth conversions and so forth.
Right.
We have a window of time that
we know tax rates are historically pretty attractive.
Yeah. And if you poll 100 people and say, where do you think tax rates are 20 years from now, probably 99 of them are going to say higher. So that's why we're doing some of that, because we do feel that there's a good chance that those might sunset. Tariffs is another way. Trump has made, we saw it in his first presidency on the campaign trail. He's made no secret about the fact that he may, increase tariffs again. Well, that can affect markets. And then the third way, sector performance. People want to know what does well with certain presidencies.
Right.
I think in the long term, it really doesn't matter. But, if a Republican's in the White House, certain sectors tend to do well.
So on that note, I think this is interesting. Okay. So I've got some data. So Trump, if you're looking at Trump's presidency from 17 to 21 and Biden, taking over after that, the best performing segments of the market with Trump, it goes U.S. growth, S&P 500, emerging markets, U.S. small cap, world, U.S. value. Commodities were the worst performing.
Okay. And what was the best performing?
U.S. growth.
In the second?
Just S&P 500.
Okay.
Yeah. I don't know how this exactly, not necessarily how I would have broken it down, but, and then if you look at Biden, Commodities is number one.
Interesting.
Now, this is a very
Sure.
interesting time period with COVID and
Yeah.
rates, but commodities were number one. S&P 500 was number two, so same as, and then you had U.S. growth, U.S. value. Worst performing was emerging markets. So there's some slight subtle differences, to be honest. The biggest difference was commodities was the worst performing during Trump and the best performing during Biden.
Mm-hmm.
That was the biggest swing that you saw there.
And you see that a lot in, I mean, what they're going to push, kind of their platforms and so forth. Republicans, aerospace, defense tend to do well. Financials tend to do well. Small and mid cap. The two best that typically do well under a Democratic, at least initially, oftentimes it fades, healthcare and green energy
Sure.
stocks. And so, I mean,
Makes sense.
It does. And so when we tell clients that overall it doesn't make a difference, I mean, kind of what we're saying is long term. Don't lose your long term focus just because
it doesn't make a difference from a perspective of there's no historical trend that's been consistent
That's
enough
correct.
to say that there are predictable trading opportunities in the short term, because like any trade, you got to get it right twice. You got to get it right on the entry and the exit.
Yeah.
Right. And so if you don't have pretty strong empirical data that shows this is when the timing of when to do that, and then you're better off just not trying to time it, because data shows if you just stay invested, you're much better off than if you try to do the extremes. And kind of wrapping up this conversation on the planning, you mentioned Roth conversions and those types of things. We've been doing a lot of the planning with clients and talking about that a lot. I know Eli talks a lot about it a lot, like on data briefs and different video segments that we have. And if Trump were to get elected and the current tax situation were to be extended, then those rates stay in place longer, and we have a larger window to look at planning opportunities, because it doesn't change the fact that I still think rates are probably higher in the future,
mm-hmm.
right? It just gives us more of an opportunity over the coming years to get things done from a tax planning perspective.
And I think what is facing either president, let me back up, either party over the next 4 years is, even with Trump, as bad as he might want to keep those, tax cuts in place, we have a revenue problem. I mean, we've got to raise revenue.
We have a spending problem.
We have a spending problem.
Which is why we have a revenue problem.
That is correct. There is going to be pressure on the next president to get revenue or increase revenue from somewhere. Yeah, the spending's an issue, but it seems to me no president wants to be the one to say we're going to buckle it up.
They don't, but I think that you have more people today than ever that would agree with you that even on the Democratic side, that hey, it's more of a spending problem than a revenue problem.
I think so.
I'm not saying everyone would agree with that, but you just the headline numbers of where our national debt is, how bad our budget is year after year. It's hard not to look at that and say, like, okay, we need to rein things in a little bit.
Yeah.
And there might be some opportunities to increase revenue in a responsible way that's not, crushing to businesses and crushing to individuals. But that's never going to fix the problem if spending continues to climb at the rate it has.
We need to get an election cycle where everybody's up for re-election or term limited out, where nobody's worried about getting reelected.
See, I think,
and then I think what they'll do is they'll make some of these decisions that are somewhat unpopular.
And I wouldn't be surprised. I wouldn't be surprised if Trump won, if he tried to do some more extreme things. Now, the downside to Trump is he wants to be liked so badly.
Yeah.
But he's not worried about getting reelected. He's old.
Yeah.
Right. And so it's like what the next 30 years looks like for him out in the general public doesn't matter.
Sure.
Right. And so maybe he can get some wise counsel around him that says, hey, this is an opportunity. If to truly kind of better position ourselves moving forward and maybe get some more extreme things done from a spending and, budget perspective.
Was it the latter part of Clinton's presidency the last time we had a balanced or a surplus?
Yeah, I think so.
Yeah, I think it was. I mean, and contrary to what a lot of our, conservative Republican friends would like to believe, that happened on a Democratic president's watch. And so it's going to take some tough decisions.
Well, we've got we've got Social Security issues coming at us over the next, 10 years. And some real, problems that have to be solved.
Mm-hmm.
Like that can't just be kicked down the road forever.
Yeah.
And, so I think everyone just needs to be generally aware that, there are going to be compromises and gives and takes on both sides that we're going to have to see to get stuff done.
Yeah. We as a country cannot continue down the road that we're on indefinitely.
Yeah.
It will not end well.
Agreed. So anyways, we wanted to spend, that's more about politics and elections that we would normally spend, but we have the election coming up. It's been in the headlines with everything going on with Biden and Trump, and we're getting a ton of questions about it, understandably so, and we talk about it a lot internally. So we just wanted to get on here and kind of look at some of the data that should, hopefully is encouraging to say there's no historical evidence or nothing that says like you should be concerned from an investing perspective that something's going to happen based on how the election outcomes
we're
fall into place.
Yeah, we're sitting right around 3 months away from an election. A lot can happen. I said earlier the two candidates, and I thought, you know what? There's a chance that one of the current candidates
is not a candidate.
Sure. And so, there's so many wild cards, and that's why, you just cannot base money decisions on things like that are completely out of our control, and have a long-term plan in place and stick to it.
Yep. I was looking, last thing, I know this is kind of just throwing it out there at the last minute, but it's interesting. You look at the last, how many is this? 12 U.S. presidents.
Yeah.
The market did the best. Now you're going to get arguments about why, and I get that. Just telling you the numbers. The market did the best during Clinton and Obama's presidencies, just from a gross return perspective.
Yeah. Sorry, I just had a thought, but
yeah, I don't know if I want you to share it based on.
No, and I will share it because it's not. Yes, that doesn't surprise me. Many Republicans would say it's because of policies put in place in the prior administration.
And I think there's some absolute truth to that.
There are, when you look at the length of an economic cycle.
Sure. And that's why I prefaced it with that you would get some pushback on. But I go back to say the last three presidents we've had, Obama, Trump, and Biden, I've heard it from both sides. If so-and-so gets elected, when Obama's running,
the world's coming
in, the market's going to crash, and the market was up 181% with Obama.
Yeah.
The other side was saying it when Trump got elected. He's a wild card. No one knows what he's going to do. He's not going to, and market was up almost 70% during his presidency. Biden, same thing. Biden, it's up 36%. Right. Yeah. And so and you heard it on all three election cycles from different sides of if this person wins, the market's going to crash. And it hasn't happened.
Somebody a lot smarter than me and with a lot more time on their hands can probably day trade this, but clients, long-term focus, stay invested.
Absolutely.
Work with a good financial advisor that can make adjustments here and there, but nobody's gotten rich, I think.
Don't get caught up in the emotions of
correct.
And just turn off the TV.
Yes.
So, all right. Well, anything to wrap up?
No.
All right. As always, we appreciate you guys listening and watching. Give us a like, subscribe, leave us a comment. We'll be sure to mention those in upcoming episodes, and we look forward to seeing you guys next week.